So welcome everyone. Thanks for joining us today. I'm Mike Leavy. I'm with Integris Wealth Management, and we'll be joined by Brian Trouette, who's an expert in the insurance industry, who will help us understand how to navigate the difficult environment we're in these days. At Integris, as wealth managers and financial planners, our job is to look at the entirety of our clients' financial plans. And an integral part of that is the insurance piece. If you have a catastrophe happen in your life and you're not properly insured, the best laid financial plan can easily be derailed, I should say. So what I'd like to do is introduce Brian. He's an insurance agent. He has the Trouette agency. He's got 22 years of experience. And as I said, he will help us understand this difficult environment in California, where we've got a lot of catastrophes happening, with the fires and so forth. And it's very difficult these days to find insurance. So before I hand it to Brian, I'd like to ask Ken Cranstone, my colleague, to let us know a little bit about the technicalities of asking questions during the call and so forth. So Ken, can you help us there?
Yeah, thank you so much, Mike. If this is your first time attending a Zoom webinar, first of all, welcome. We're glad you would make your first webinar with us. But I just want to let everyone know here that we really do encourage engagement. If you look at the bottom of your screen right now, you'll notice a toolbar. And one of the icons on here is for the Q&A button. As you have questions throughout this presentation, please feel free to ask Brian by clicking on this icon. You'll be able to type in your question. And from there, I will be monitoring the question queue. And as there are some opportunities to pass your questions along to our expert, I will make sure to do so. But before we hand things over to Brian, I just want to offer a quick disclaimer. This presentation is intended for educational purposes only. Please consult with an appropriate licensed insurance agent before considering any changes to your current coverage. And with that compliance disclaimer out of the way, Brian, I would love for you to kick things off, maybe take a moment to introduce yourself, and let's dive into insurance in California.
All right, so I'm going to share screen.
See if the magic of Zoom works here. There we go.
Is that what you were expecting to see?
That's exactly what we're expecting to see. Thank you.
All right, cool. Well, so Mike introduced me. So what I want to say is, to start, this is a class that's an amalgam of several classes that I've done over the years at Financial Planner Association. And there was a lot of questions on what's going on in California because of fire and legislation. And so I put that in, but I also wanted people to know what they can do to, protect their coverage and what type of coverage they should have. So if it seems like I'm jumping around a little bit, it's because I'm jumping around a little bit. And feel free to answer or, ask questions. And if you have any questions afterwards, anyone's always welcome to contact me through Integris or directly. You don't have to buy any insurance to ask questions, so please don't feel like there's an obligation. But here we go with fire, law, and insurance chaos. This is state of the nation in California. And whoops, why isn't this working?
Might be the laser pointer on. Oh, there you go.
Okay.
Now it's running.
So 2017 was a watershed year in California. Some things happened that we never thought could happen. We lost several entire communities. And in 2017, the fire losses were $18 billion and thousands of houses burned down in Sonoma County. And a lot of you may remember the news, and it's still going on, right? Every year, fire season, which we just had a fire in Laguna Beach this week. So welcome to fire season in California. It's February. Importantly, carriers were paying $2 for every $1 they collected in premiums. And by 2021, that had risen to $4 to every $1 that they collected. So this is a big deal to the insurance carrier, and it's a big deal to California because carriers aren't making money. It changed our industry perception of risk. So the picture that I had on the previous screen here, this is Coffee Park. It's a community up in Santa Rosa, and it burned down to the ground, all of it. That's an aerial photo of it. And the thing about it is there was no brush, right? This community, it was a wind-driven fire. some fire on the outskirts. There was fire on the outskirts of the community. The wind caught another house and it burned house after house in a conflagration. And that happened in several areas in Sonoma County that year. So we would have said that Coffey Park was immune to fire before 2017. And we would have said homes on golf courses were immune to fire. And we would have said coastal influence makes a difference. If you're close to the ocean, we don't believe that there's going to be substantial fires. If you have vineyards around you, roads as fire break, stucco and tile roof, people think that, that's non-flammable. But I have video of houses that are bursting into flame 300 feet away from where there's anything flammable because of heat driven by wind. So the insurance companies are all trying to figure out what is risk now. And this is a picture of the Carquinez Strait here. There was a fire there, and that's the bridge that goes from Vallejo to Concord or Pacheco in the Bay Area. And that fire jumped the Carquinez Strait, which is a couple of miles. So fire breaks have become sort of a myth now in California. And in the middle of all of that, this started in 2017. There was a lot of issues with claims. So all these thousands of houses burned down. And the first thing that people were calling out is carrier bad faith. Oh, these guys aren't doing what they're supposed to do. That ended up being mostly perception. I mean, there are some carriers who didn't perform well, but I do a lot of pro bono work in the insurance business. I help people for a foundation who have lost a home and don't have advocacy. And most of what I found wasn't bad faith, but there were a lot of things that we did find is that houses were almost universally underinsured. People hadn't paid a lot of attention to their insurance, and their carrier hadn't paid a lot of attention to their insurance, and neither had their agent. The sheer volume of claims was a really big deal because carriers were not staffed to have that many people lose homes at the same time in one area. So there was all kinds of shuffling around. You had people adjusting claims in California who'd never adjusted a claim in California. And disorganization is a big deal. I saw a lot of clients who had submitted claims that were, in handwritten notes that no one could read, or they just were not organized. And so when you have that kind of volume with a submission disorganization, it would go to the bottom of the pile and people wouldn't even get a call back. And there was an overall misunderstanding of how a claim process works. The claim process is a very formal process and it takes some time. And people weren't expecting that amount of time on claims, particularly with all the other things going on, the time periods got lengthened. But there was a lot of dissatisfaction and a lot of social media going on, and it got to the level of the legislative body in California, and everyone was saying someone should do something, and someone did, and that someone was the California legislature, and they passed some laws so that people could, get more insurance from the insurance carriers. And it's I'm going to say at the front that these laws they didn't involve the stakeholders at all, and so there's going to be some unintended consequences. But here's the basis: is that an insured can use the replacement cost of their home and any extended replacement cost and cash out in a total loss. Normally, you can't do that on an insurance policy. There's a few policies that will, but normally, if you don't rebuild, you only get a depreciated amount of money. So California was trying to help consumers get more cash from insurance carriers in emergency. An insured could use other structures. So other structures is usually a coverage grant for fences and decks and things like that. Now they're allowing people to go take these other structures and put it over on the dwelling bucket and increase their coverage. And they also were saying that, if there's building code upgrade coverage, that you have to pay that out in cash if they want it. And they added some new minimum loss of use provisions, saying that there has to be at least 24 months and then another 12 months if it's the project is delayed for cause. So what happened with that, though, is insurance carriers were not priced on their policies to conform to the rules. they were priced with a model where some people aren't going to rebuild, or this, how their policies work. So because the carriers weren't priced for these rules, and they also couldn't increase their premium. We have this thing in California called Prop 103, and a carrier can't just increase their rates if they're an admitted carrier like a Safeco or State Farm or those types of carriers. The Department of Insurance has to approve their rate increase. And so now you have carriers that aren't priced to perform the way the law says they have to, and they can't raise their rates. And so what happened was a lot of the admitted and non-admitted carriers, admitted carriers are carriers that file their rates with the Department of Insurance, and any disputes are adjudicated by the California Department of Insurance. Non-admitted carriers don't file their rates with the California Department of Insurance, and they still have to follow California law, but they can raise and lower their rates however they want to do it. But those carriers started withdrawing from markets and raising rates where they could, the non-admitted carriers, because the law increased their aggregate total exposure. When you take a house and say, we're gonna make you pay extended replacement costs plus the replacement cost to cash out, you're actually increasing that carrier's exposure. And so the carriers wanted to raise rates. A lot of carriers introduced non-admitted carriers so they didn't have to follow the rate rules on Proposition 103. To form a new carrier is a really big legal expense for an insurance carrier. They have to create this other company. And that means that they believe that this crisis is not going away. For someone like Chubb, and for someone like, for instance, Pure and Cincinnati, these carriers are big, broad form carriers that want to do business in California, but they started creating their own new carriers.
Brian, question for you.
Yeah, go ahead.
If I'm a consumer of insurance, so I'm buying insurance, do I care whether it's a non-admitted or admitted company that I'm doing business with? And what are the pros and cons? And should I even think about that?
It's worth thinking about, because if you can get coverage in a non-admitted, or excuse me, an admitted carrier, you have a lot more rate guarantee. They can't just raise your rates. We're dealing with a lady who called us yesterday. Scottsdale Insurance, which is a nationwide non-admitted carrier, insured her house for $8,000 last year, and this year they raised that rate to $41,000.
Thanks.
And so it's a big deal. If it was a nationwide, they could have maybe raised it 6%. So it is a big deal. And the other thing is that non-admitted carriers don't fall under the Department of Insurance jurisdiction. So there's no, if they break the law, they might have to be able to be held accountable, but the Department of Insurance won't come in and say, hey, we're punishing you for raising rates or slow claims or whatever. The Department of Insurance doesn't have anything to do with it. So it makes a big difference. And,
thank you.
And then reinsurance is something where carriers will sell insurance to a consumer, and then they'll turn around and sell part of that risk to another carrier to disperse the risk so that no one carrier has too much risk. Well, the reinsurance carriers can charge any rates they want. And with their rates going up, it made admitted carriers were paying more for the reinsurance than they were collecting for the actual insurance. So carriers have been canceling insurance all over California, withdrawing from markets, withdrawing from zip codes, withdrawing from entire areas of California. AIG left California. It's a huge move for an insurance company to leave a state, but they're doing it. Other carriers are amending their policies downward to offer less coverage. And the other thing is that carriers are starting to move to monetary statement of loss. So the carrier might have said actual loss sustained on their policy. Now they're saying we're going to pay $120,000 or $80,000 or whatever the number is. And you can spend as much time as you want, but the only amount we're going to pay is that. So they're starting to limit what they're doing. And the legislature has not acknowledged these problems at all. So there's a lot of things they could have done, which would be a long conversation and more technical than anyone wants to know. So I'm going to go on from here. But unintended consequences of the law are a big deal in California. Whoops. So what's happening is now there's an insurance carrier called the FAIR Plan in California. And the FAIR Plan is a partnership between California admitted insurers and consumers. And the way it works is carriers that are admitted to the state of California to do business have to pay a certain amount of money to the FAIR Plan. And that money is not disclosed. There's no records of it. They don't disclose it to the public, and we don't know how much money the FAIR Plan has backing them. They don't disclose that either. But what it does is it's an insurer of last resort. So it was created, many years ago in California, so people could get mortgages who had houses out in the woods where they couldn't get insurance. But the FAIR Plan is becoming a larger and larger part of the California insurance environment as all these other carriers are leaving and or canceling, and the only coverage left is really the FAIR Plan. And the problem is they only have a 3 million aggregate limit. So aggregate means the amount of insurance that the carrier will pay on any one loss. And if you have $1 million house and you have 700,000 worth of contents and you have loss of use, you're going to hit a 3 million. You're going to hit that 3 million aggregate by the time you're done with a claim. Your house is like a $2 million replacement cost house. You're going to be over that 3 million aggregate. So it limits the amount of insurance that people can actually buy in their worst case scenario. It still only has 10% for code upgrade coverage. So there's a limit in the policy. And I'm going to talk a lot about this in another couple of slides, so I'm not going to spend a lot of time on it. But your loss of use is included in the aggregate. Your contents are included, other structures, debris removal, everything is insured in this $3 million. That doesn't leave a very broad form policy. Here's what it looks like in real life. So we had an AIG policy. The guy was paying $2,500 a year, call it $2,463. We had to move it to the FAIR Plan. So now that coverage went from $2,463 to $4,103. And this plan here only covers fire, lightning, and smoke. So we had to use another carrier called Bamboo, which we'd never even heard of 4 years ago. They're a small carrier that's writing a policy alongside of the FAIR Plan. You have to write a second policy to get things like liability and vandalism and water damage and things like that. But if you look at the coverage differences, this is $1 million with a replacement cost cash out. Extended replacement cost is 100%. They have no extended replacement cost here. So the AIG would have rebuilt this house out to 2.2 million. This is your limit, as much as you can get. Code upgrade here is 100%. Here it's only 10% and included in the aggregate. And on sewer and water backup, they had full coverage here. There's only $10,000 on this Bamboo policy. Bamboo is a carrier who could go bankrupt if they had a big water or a windstorm in California. But all these little carriers started coming in because large national carriers are afraid that if they're writing next to the FAIR Plan, somehow the California legislature is going to draw them into losses here for fire. So there was a lot of fear on the part of the large national carriers for a long time. And so this is what it looks like. So we went from paying $2,500 to more like $6,000 for less coverage, when if absent of Prop 103, AIG could have just raised its rate to $5,000 or $6,000 and they'd still had a better policy. But we can't do that. And now we are where we're at. These guys have a less coverage, more money.
Question for you on this, Brian.
Yeah.
I'm looking at the Bamboo coverage, which has a 50% extended replacement cost. And I'm just wondering, but that's not going to cover fire, right? That's just going to cover the few things that.
That's exactly right.
So
the extended replacement cost on Bamboo is not going to be covering anything they lose here. Mm-hmm. And the two most likely scenarios for a loss on this house are sewer backup, which is their #1 cause of loss, in my insurance agency, and then fire. So the extended replacement cost, they have 10,000 for one, and then they have, just the base coverage here for the other. So I'm not a big fan of it, and it was fine when it was just a policy that everyone, a few people had to have, but this is becoming mainstream insurance in California, in places where you wouldn't have thought, Walnut Creek, California, Danville, California, Pleasanton, California, not Lake Tahoe, or, I can't think of another, there's some really remote cities where
like Kashawa, around us would be Kashawa or Big Sur, those types of places.
There you go.
Well, and Brian, actually, one other question here from an anonymous attendee. Can a person buy similar insurance with more than one company simultaneously? So maybe back to that bamboo policy where it was the difference in coverage. Could you get like a bamboo policy and, I don't know, some other company to do another little chunk of insurance, or is it really one insurance policy per house?
It's a really good question. And the answer is, every insurance policy says if there's other insurance, we're going to share whatever loss happens with the other insurance company. So you could pay for two policies, but if they find out about each other, what they're going to do is reduce what their payout is by what the other one pays. They will split the loss. So you really want to have one policy per household, because you open up a can of worms trying to deal with two adjusters and two carriers if you have that kind of a loss. So in 2022, here's where we're headed in California. I mentioned that AIG had left the state. Other carriers are reducing their admitted coverage. They're still canceling insurance. Carriers are asking for a wildfire deductible. So this would be similar to earthquake coverage, which usually has, a 15% deductible, but the wildfire would be a 1 to 15% sliding scale is what they're floating. So we would eliminate smaller claims like smoke damage and things like that and turn it into a true catastrophic loss policy. Carriers like that idea, but our insurance commissioner does not like that idea. The increased flow of business into non-standard markets and fair plan, right? So we're getting more and more companies, more and more insureds moving into the fair plan. And that means that the funding for the fair plan is getting less and less, because the carriers that are funding the fair plan are writing less business in California. So we have an unsustainable migration into a publicly funded company. The other discussion that they're talking about right now is creating a pool like California Earthquake Authority, where carriers don't cover any wildfire, and there's a state-run policy just for wildfire. And that actually could end up being a good thing if it happened right, if they did a good job with it, because that made earthquake doable in California once they created that. But there's a lot of conversations that need to be had with stakeholders on that. So our issues going forward are sustainability. There's fewer players, there's higher costs, and solvency issues. I'm very concerned that Fair Plan does not share its financials. When I called them, they answered me, or I emailed and said, I'd like to know what you guys have in terms of financial backing. And they said the Fair Plan financials are sent out to member companies quarterly, but are not available for public distribution. That was their answer from their vice president of finance. So that's where we are in California, and the reasons why carriers are canceling policies. And I'm going to jump now to, what can you do to avoid cancellation? First of all, don't be filing any small claims. You want to have a deductible of at least $2,500 or $5,000 on smaller homes. And if you have larger homes, I'd think $10,000. And if you have a house over $1 million of replacement costs, you should really be looking at a $10,000 or a $20,000 deductible typically. Don't file any small claims if someone steals a bicycle, because you lose a bicycle and then the next year you have a smoke damage claim, you're going to lose your coverage for frequency of claim. 2 claims in 3 years will get you canceled. And if you're with carriers that look at this type of stuff, you want to make sure you're clearing vegetation, installing gutter guards, narrow mesh venting. There's venting that you can that you can buy for the house that keeps embers from getting under the house. 80% of the houses that we've lost in California over the last 4 years have been because of wind-driven embers. So if you've got bark in your planters next to your house, I have several videos, ring videos and different types of applications where bark has, embers have fallen into a planter, and then that ignites and the house burns down. And we know how it happened because people left their security systems on when they were evacuated. It wasn't fire that burned it down. It was an ember that dropped in their yard and then caught their yard on fire. So I mentioned high deductibles, and be careful about lapsing a policy. So there's some carriers that have not been canceling, but if you lapse that policy, they will not reinstate it. So, depending on where you are. So you want to make sure that you pay on time and you don't let an expired credit card cause a lapse. This is one of the largest reasons for lapses is people are paying on a credit card to get the points. And then, the year turns over, they have a new credit card. The carrier will send you this little quiet note, one line that says, hey, pay us, or we're going to cancel. And then you miss that. And now you don't have any insurance. So
a question for you, Brian.
Yeah.
Is it risky for me to just inquire about my insurance? So to ask the carrier, do I have enough insurance? Should I increase my insurance? If I ask questions like that, am I risking cancellation? Should I just sort of leave them alone? Or
no, you should. It's not risky, because if it were risky, they'd already canceled you. So it makes a lot of sense to look through your insurance and make sure you're insured to value, and talk to your agent and say, I'm very concerned about the coverages, and do I have enough of these types of coverages, which I'm happy to give you a list of for your clients. I don't have it in this presentation, but I do have a list that I think is really important. You want to be doing that so that you're insured to value, because if you're underinsured and you have a loss, it's the same thing as not having any insurance if you can't rebuild. So
Brian, one other question before we move on. It was just back to the FAIR plan. It was just a question from the crowd. Is the FAIR plan a state-backed company?
Technically, no. It's run by the state of California, but the carriers who are admitted to the state of California give money to it, but it was created by the state of California and administered by the state of California. So there is no true backing from the California, there's no California money in the FAIR plan.
Got it. And one other question just popped up. What is the best way to determine the proper value for your coverage? Building cost seems to vary wildly these days. Rebuilding costs.
It does. I mean, we use a per foot and class model. So I know, like, if I told a contractor, hey, I'm going to build a new house and this is how I want it, I'm going to have stone and I'm going to have tile and marble and this kind of stuff, he'll give me an allowance for all of those appliances if I want a commercial kitchen, that type of thing. So it's really important to know that a lot of the carriers are, especially middle market carriers, which I'm going to talk about what that means in a minute. They're not great at capturing really high value items. Like, State Farm doesn't technically insure a lot of commercial kitchens. USAA doesn't either. They were designed for something different. So you really want to, in the absence of anything else, if you have a contractor that I'd ask a contractor, what would rebuild this house foundation included from the ground up? Asking a contractor that question could really be useful if you have a friend of a friend or something. Or we usually get pictures of the house. I have a construction questionnaire that we use. So if I know there's certain type of high-end flooring and high-end kitchen, I know that we're, our average in the 680 corridor, for instance, between Walnut Creek and Pleasanton, our average is $400 a foot. I mean, and that's increasing all the time. Most of the houses we insure in that area are above the average, because remember, our average might include some rental units that are really kind of builder's grade, and then some houses that are, $800-900 a foot, which it's not hard to spend $800 or $900 a foot if you're buying custom stone. So I'm going to jump on to the next slide. These 3 slides relate to the problem, like what happened in 2017. A lot of it happened, the way the insurance worked and how it worked for people in terms of the claims happened because people have these 3 problems. The first is that insurance doesn't keep pace with spending and lifestyle. People will build out a custom kitchen, and some of this is, liability stuff, like they'll have a housekeeper or a nanny, or, they sit on a board of directors. But on the property things, people will remodel their entire house and never call their insurance agent. And so there's a shift in the value of the house, or there's a shift over time. And so a lot of people who had losses in the most recent years never even realized that their house was insured at about half of what it should have been. And this is especially true if you live out of state. If you're in like Colorado, Arizona, North Carolina, those states have seen enormous building cost increases. California has always been expensive, but those states are crazy expensive compared to what they were. So that's the core problem number 1. The second one is people think of insurance as a commodity, and it really is not. When you're buying insurance to hit a price point, what you're doing is taking a couple of things like the price and the replacement cost of the home. But the reality is that for high net worth families, insurance is a complex tool that's designed to indemnify you against loss. And it means you've got to spend at least as much time thinking about it as you might with your financial advisor when you decide what your risk tolerance is for your investment portfolio. It makes a lot of sense to at least know what you have on your insurance. And the third one is, because of the first 2, people believe they're covered, but they're not. So the question is, are you in trouble? Can you, have you had a policy review? And if you haven't had a careful and thorough analysis of your insurance, it's probably time to get a trusted person to do that for you. Because, whether you lose a house in a wildfire or you have a one-off loss, you could be very surprised at how your insurance works. So that brings me to, this is probably the most important 2 slides of this conversation today, because this explains what the insurance business looks like. Excuse me. And most people, and a lot of people even in the insurance industry, don't realize that this exists. So at this end of the spectrum, you have really inexpensive policies with limited coverage. They might not have any sewer backup, or they have no code upgrade, or they have an actual cash value form, which is, hey, we're sorry about your loss, but we're going to give you the depreciated value of everything on your house. And out here, you have these policies that are cash out options and full code upgrade and really easy to get money out of the carrier, and they're more expensive. Most people are purchased right in the middle, which is what we call the middle market. And these carriers have designed their policies statistically to meet the losses of about 90% of the consumers that buy insurance from them. So, Liberty Mutual may know that the average loss for sewer is like $5,000, or people aren't really going to use a lot of extended replacement costs. So if they have 20 to 50%, they should be okay on a standard loss. And, maybe they've got limited replacement costs. So we'll give you true replacement costs for this house if you rebuild it, right? Replacement cost is what it costs to replace it right now versus, hey, this thing is 10 years old, so we're going to depreciate the value for the 10 years of use that you got out of it. So this continuum is, when people are saying, well, I'm going to insure a house for $1 million, the rate on $1 million house down here and the rate on $1 million house up here are really different, but the coverage is really different too. And this is what's really important to the insurance carriers. If you have an average claim where 90% of the market falls, you're never even going to know you had a peril there, right? Because, oh, I had a small electrical fire, they redid the cabinets in the kitchen and everything is fine. And if you have no claims, you never think about it. It's right here where you have sublimits. You have places in your policy that the carrier said, we'll pay this, but not that, if and then. Those statements that are in those insurance policies are where carriers design policies to protect themselves from catastrophic loss. So if 90% of their losses fall right here, and only 10% are catastrophic losses where people are out hundreds of thousands of dollars, a carrier can still claim to have a 90% customer satisfaction rating. That's really important. So whenever somebody says, oh, we have a 90% customer satisfaction rating, I think 1 out of 10 people are unhappy with your claims, not, woo, 90%. It's designed to do that. These two slides are really what the insurance industry looks like. And our legislature doesn't know it, and most insurance agents don't know it, because you're in a hurry to buy insurance because it's boring, and agents are in a hurry to sell insurance because they're salespeople. And when you put a person who doesn't care about insurance next to a person who wants to sell something, you end up with potential problems in large scale claims. So that's what the business looks like. And I'm going to shift again here and talk about claims. In all of my claims advocacy that I've done, and that includes, our clients, although our clients tend to be more prepared because we talk about this, but people who have lost a home, the first thing that they're worried about, what they're really thinking about is, I just lost all of my kids' photos. There's a lot of people who might be on this call. I'm in my 50s. And I have like a continuum of life, right? Like where I have a lot of digital stuff and I have a lot of stuff that's not digital. There was a time when I had a lot of photos and everything that were not in digital form. And there's, people like my parents that don't have anything in digital form. My dad has an iPhone, but he can't use it. So knowing that you have things that are important to you, like your children's art or letters that were important to you, or something that you can never replace, is really important, because in a fire or a total loss on your house, those things are gone forever. And you're in the process of mourning that stuff. And yet now you have to deal with an insurance adjuster and rebuild your house, and make decisions and find out either good or bad news or whatever. It puts you in a much stronger position to be prepared for something like that if you're emotionally prepared for it. And this other thing is if you've done an analysis of your insurance, if you've made a decision on how you're going to be covered and you have a loss and it doesn't quite go the way you want it to, at least you're prepared emotionally. So I would say that preparation for claim is as important as your coverage, because everything in my house except for my kids' art is pretty much replaceable. I have some tools from my grandfather and stuff like that, but I've got dive gear I should really throw away that I'm never going to. I've got a garage full of stuff that I'm never going to throw away, but if a fire destroys it, I'm never going to buy it again either. So that's, ask yourself what's valuable and protect those things. Any questions on that? I think it's, or anything so far?
Nothing from the crowd on that.
All right. So when we start doing analysis, we look at some things that are really important on these the carriers or the policies. And so title and named insured, a huge number of policies come to us for review that have the wrong named insured information on them for a number of reasons. But if you have title to something, you have an insurable interest. And if your title has changed, or you've added a trust, or you've created an LLC, or you've gotten a divorce, or whatever it was, it's really important to have the right named insured on your policy, because if you have, at the time of a loss, you're required to show insurable interest. So if you have a car that's titled to your business and you don't have a title to that car and it's in your name, they may not owe you any money, or a house, or whatever. And you got to have the correct policy form. A lot of our clients will live in a home and then they'll keep the home and buy a new house that's a nicer home and rent out the other house. And so I'll see that in the same town, maybe even they have two homeowners policies. If you have a homeowner policy and you're renting out that house, you should really have a dwelling policy. That covers liability and property related to renting something out versus living in it. The correct form is a really big deal, and carriers don't ask a lot of questions. You call them up and say, I want some coverage. They sell you what you ask for. So if you don't know the difference between those two, you can get into trouble. I talked about replacement cost a little bit. You know, undervalued homes is a very common problem that we correct. Extended replacement cost is an inflation hedge. So the way it works is usually a policy will have, you know, let's call it $1 million of coverage. And if it has 20% extended replacement cost, it means that if there's a big demand surge, the carrier will rebuild out to an additional 20%. So 1.2 million versus the 1 million. That's great. Since 2017, most of the houses that have been burned in a true catastrophic event, I'm seeing the rebuild on those houses at about 180 to 190% of the original insured to value rate. So even a 50% extended replacement cost may not rebuild a home. So then you got to ask yourself, am I really insured to value? You want to make sure everything is tight when you're dealing with a carrier that has lower extended replacement costs. I'm going to talk at length about ordinance and law in a minute, so I'm not going to stop there.
A quick question on a replacement cost. If my house is underinsured and I don't bring it up to par, so let's say it was 500,000 a few years ago, and now it's probably 8, but my policy is only saying 6, you know, and something happens, and let's say I have extended coverage, will the insurance company have a problem with the fact that I was underinsured in terms of?
Maybe. Yeah, it depends on the carrier. Some carriers have an 80% to value ratio. So if you're not insured correctly, they'll lower your coverage if you're not insured to value. And
well, is it my responsibility to keep checking in with them, or if I?
Yes.
Okay.
Yes, it's your responsibility. That says so in every policy. And the other thing is, if an insurance agent ever suggests that you use your extended replacement cost to control your insurance cost, like let's say the house is a 50% extended replacement cost, so we don't need to insure at $1 million, we can insure down to like 700,000 because we have this extra coverage. That's grounds for losing a license in California. It's illegal, and anyone who suggests it deserves to lose their license, because that extended replacement cost is specific to demand surge. You don't get it unless you can prove there's a reason why it's more expensive.
Got it. Thank you.
And one quick technical comment. I noticed that there's a raised hand in the crowd. If you'd like to ask a question, if you could please click on the icon that says Q&A. I know it's right next to the raised hand. And if you'd like to have your question answered or asked, if you could please direct it to the question and answer section so I can read it. Thank you.
Okay, so am I going or are we waiting?
Oh, and one question just popped up here. If my insurance company sent someone out to the house to inspect and appraise following a remodel, are they on the hook for valuing it correctly?
Maybe. It puts you in a much stronger position, no question about it. So they can't say it was underinsured necessarily, but you could still run out of coverage. Like for instance, if you did the remodel 2 or 3 years ago, that remodel could be worth another 30 or 40% of what it was worth, you know, at the time they did the replacement cost estimate. So it really depends on when they did it. But if it's fresh, I think you're probably in pretty good shape, because they're very careful about that now on those replacement cost estimates.
And one final comment. I know we're just coming up here to the 12:45, the quarter hour. If anyone needs to disconnect, please know that, Brian, I think we have you for an extra 15 minutes. We had a little bit of flex built into this presentation. We have time to continue to present and answer questions, but if anyone has any questions or wants to continue, please do so. If you don't, please know that there will be a recording of the section you aren't able to make, but we really appreciate all the engagement. And as I say that, we've got one other question that just popped up. How often should we ask appraisers or folks from the insurance company to come out?
You know, I would do it every couple of years, or at least talk to your agent about it every couple of years, because we've seen like a lot of the carriers right now are using 12% inflation rate increases in California. So they used to be 5, but now they're using 12. So over 2 years, that's 24% increase. But is it enough? In Colorado, it's 12 right now, but we've seen the increases at 20%. So it's not a bad idea to look at this every year and ask yourself, am I insured to value? And depending on where you are, like if you're in the Bay Area, that's a different cost basis than if you're further out, like up in Redding or something like that. You still get some cost break out there.
Got it. And maybe just one more quick question. I know we've got a few in the queue here. I'm going to let you get back to your presentation, but in the same vein of inspections and people visiting and checking out the property, currently there are virtual inspections being done. What is the impact of having, I guess, a virtual inspection done? Is it the same kind of situation where they might be on the hook for that appraisal value?
Yeah, the virtual inspections are okay. I prefer in person, but there's a lot of reasons why we can't do that. We just had a virtual inspection, they got it wrong a little bit, and we had to correct it. But we were working with the client on it, right? And there's a reason that they didn't want to have someone out at their house. There's a immunocompromised person who lives there. So, I'd rather have a virtual inspection with some back and forth on what the flooring and the cabinetry is like than have someone out to the house and endanger a family member. So the virtual inspections are fine as long as everybody's engaged. If that makes any sense.
Excellent. Thank you for answering that, Brian. And for everyone still tossing in some questions, we're going to move a little bit further in the presentation. Brian, though, we do have a log of all the questions. Maybe some of the ones we can't get to, would it be okay if we reached out to you after the presentation time? And
yeah. I have some time after too. If I can stay on longer, if other people want to stay on longer. I gave myself an extra half an hour after this, just in case. So
excellent.
I don't know what your time is like, but I'm free. So there's 2 slides that I really want to talk about, and I'm gonna do it right now. Ordinance and law is rebuilding to code, but you have to rebuild any house to the current code. And it's a lot of times people are confused about it because they'll remodel something and it'll be to code, quote unquote. But the problem is when the fire department opens up all the walls in your house, that changes your code status. And it's really important to understand how this works. So on a $1 million home built in 1978, a typical policy might have, in the middle market, might have 10% code upgrade or ordinance and law coverage. So if a rebuild has 40% code changes, that means that 40% of a 1978 house built in 2022 there's a 40% difference in the types of building materials and electrical and seismic code. That's a big number. That's $400,000 of the $1 million if that home is insured correctly. And so that's $100,000 of coverage. So the client could be insured to value and have this sublimit of 10% code upgrade and be 30% out of pocket on that rebuild, $300,000 because of that sublimit. Ordinance and law is designed to limit a carrier's payout in the event of a large scale loss. If you have a small loss, this 10% is going to be perfectly fine. And almost, I'd say probably 70% of policies out there have 10%. And you can buy more sometimes, but you have to know to buy more. So the question is how much ordinance and law? Here's a much more common scenario. $700,000 is how a $1 million home insured for $700,000. That limits your code upgrade down to $70,000. You have a difference in cost of $300,000 between your $1 million and the 700, and you still have the code upgrade of $400,000. So on an underinsured home with code upgrade limitations, you're talking about almost $630,000 of out of pocket on a home that was insured to value at $1 million. That is a huge surprise to someone. It is totally legal in the state of California, and the California legislature did not address it in their laws from 2018, and the California Fair Plan has 10% ordinance and law coverage. So it's a huge protection to the California FAIR Plan, and it's a huge oversight of the California Department of Insurance and the legislature, as far as I'm concerned, to allow this provision into a policy that's meant as a last resort policy. So the other one I wanted to talk about real quickly is sewer backup. So this is something no one thinks about, and I talk about it all the time because it is the #1 cause of loss in my insurance agency. I haven't had a true fire claim in my agency of one of my clients for 3 years. And the reason is we're really good at the underwriting now in California. You know, we had a couple of them back in 2017, but all the fire claims I'm adjusting are other people's claims. People who call me from the Financial Planner Foundation and say, hey, we have someone who lost a house. Sewer backup, I routinely in my agency have a major claim every year, and sometimes 2 to 3 of them. And when I say major, I'm talking about like $200,000 or $250,000, $300,000 of loss. We just finished out one on a house in Southern California that they had a sewer backup occur while they were away on vacation. They came back home. The whole house had been flooded with sewage that backed up from drains in the main system outside the house, and they couldn't live in the house. So we had to tear out all the flooring, all the porous materials. We had to remove all the cabinets, redo everything in that house that was touched by black water. And the $250,000 was just for the loss of use and the building materials. It doesn't even include the direct payments that we made to our to the vendors, you know, who did emergency cleanup and that type of thing. So sewer backup is one where you want the maximum amount of coverage that your carrier will give you, because if you have this loss, it's a hazmat loss. And you know, when you go to sell your house, you have to disclose that there was a sewer backup claim, and they're going to ask you specifically, what did you do on this house to remediate this claim? Because it's such a huge liability. So there's other slides. I know we're coming up on the end, but I wanted you to know that this is a huge peril that people overlook, and that is almost, you know, most policies will go as max of 10,000, and most of the coverage that we look at has no sewer backup coverage at all. It's excluded.
I have a question on both of those, the code upgrade and this. So if I identify that I have 10%, say on the code upgrade, or it's 10,000 on this, am I able to get more insurance? I mean, are there companies that'll cover that?
Sometimes. So there's carriers that still write in California that'll have 100% code upgrade, or they'll go to, or maybe they'll go to 50% code upgrade. And other carriers won't, right? I think you, like with some of the direct writers like Farmers and State Farm, I think they'll go up to 50. Safeco lowered their ordinance and law from 100% down to 50% because of the 2018 laws. But there's still a few carriers that write 100% code upgrade. And sewer backup, if they remembered to put it in, like AAA, for instance, has 10,000 max. If you add the maximum, that's what you get. And I think some of the other carriers have more or less, it depends. You know, all for us to do business with a carrier, if they don't have at least, well, I like to have 100% sewer backup. So I don't sell any carriers that don't have 100% sewer backup coverage. Uninsured motorist, sewer backup coverage, ordinance and law, and extended replacement costs are my 4 things that I ask when a carrier wants to do business with us. If they answer the wrong those questions wrong, then we will usually tell them that we're not interested. But ordinance and law is getting to be where you kind of have to make some adjustments in your philosophy, because what's available in California is what's available in California. So
and actually just I've got 3 other questions from the crowd, and we do have to kind of cap the webinar itself off at 1 o'clock here, so I want to be cognizant of that time. But just in short fashion here, how do companies view people with 2 houses, perhaps with a grown child occupying one or rotating? I only one a resident. I'm thinking the question here is to the point on dwelling coverage versus homeowners insurance. If you have like a child who's living in the property part-time and in and out, is that something where you'd still want dwelling coverage, or homeowners is still appropriate?
So all carriers view it differently. So what you want to do is you want to disclose that to your agent in an email, and you want to say, I would like you to tell me exactly what coverage I need. This is a secondary home to me, but my child lives in it part-time. Our family uses it. Here's exactly what the parameters are. And then have the agent for that carrier send you an email back with exactly how they want it covered, and then have them do it. And then you take that email and you save it. You send it to your financial advisor and have them put it in their CRM, which is their, the place where they save everything. Because if there's ever a question on a claim of what should have been, you have it from the horse's mouth exactly how they wanted that house covered. That's how to do that.
Another question here. This is unfortunate, but probably common in California right now. I recently had my home policy canceled due to living near a canyon. Where do I start? I live in Santa Cruz.
In Santa Cruz, that's probably going to go fair plan. Maybe there might be a couple. It depends on what your I'd have to map the house to know where to start, because there's still a couple carriers that do some surgical underwriting that are admitted carriers, and they're more expensive. But depending on where that house is in Santa Cruz, there's a lot of area down there that's wooded and some places that aren't so bad. So it depends.
Got it. The last question here before moving on, we've got a couple more that we'll try to squeeze in. If I change my insurance brokers but keep the same carrier, will that jeopardize my policy?
No.
Easy one.
Yeah.
A quick question about the FAIR plan. If I wanted to look into the FAIR plan, how do I do that? Do I go straight to the FAIR plan, or do I go through an agent? How does that normally work?
Typically, you'll go through an agent to do it, because they need to get two policies. They have to have the FAIR plan, and they have to have a difference in conditions policy. So you'll need an agent to do both. And then it's all direct bill. So once it's set up, it's not bad. And it's just
expensive. Yeah.
It's expensive and the coverage isn't great, but who knows, if it gets bad enough and everyone starts, emailing their legislator that they're unhappy with the insurance environment in California, and they feel that the laws are short-sighted and that they should invite stakeholders to come in and talk, maybe some legislators would invite some stakeholders in to talk. I don't know, not to get political. By the way, the Democrats and the Republicans in California are equally stupid. So I'm like a equal opportunity. There's no one I hate unless they're a legislator.
Well, and this question might actually be better for Mike. How does Integris help with insurance and appropriate coverage?
Well, we're not insurance agents, so we don't actually issue it or get paid for it or anything like that. So what we do is we try to figure out what a client's needs are just from our big picture view, and then we immediately bring in an insurance agent. And it'll depend who we bring in, kind of depends on the situation. So it might be a very simple situation, then we bring in one person. If it's complex, somebody else. That's kind of what we do. And we evaluate that in the context of the whole financial plan. So sometimes someone needs insurance to insure against something, other times they don't, depending on what type of insurance we're talking about.
Yeah. So just real quick, I know we're coming up on time. Almost 80% of the policies that I look at do not have a personal injury coverage endorsement. All carriers offer it, but agents forget to add it because it's a really long story, but they just do. Personal injury is mental anguish. If you have an insurance policy that doesn't cover mental anguish and someone sues you for bodily injury or property damage, your carrier isn't going to defend you for the part that personal injury attorneys actually are suing you for. So personal injury is a really big one. And the other one is uninsured motorist. We have a rule in my insurance agency that every client has to have at least $1.5 million of uninsured motorist. If someone in my agency writes less than that and they don't have a written document on why that happened, whether it's not available or whatever, it's a firing offense. That's how important that coverage is, because if someone hurts you and you lose your career because of it, having an extra $1.5 million to go to for uninsured motorists is a really nice feature on an auto insurance policy. So I know we don't have a lot of time, so I wanted you to know those two things I think are very important.
Yeah, and I'm actually going to go ahead and take the reins back here from you. But Brian, this has been a fantastic review. I know we didn't have a chance to get through everything. I really appreciate all the engagement from everyone joining in today. And Mike, maybe some closing thoughts.
Yeah, I mean, thanks everyone for joining. I hope this was helpful. Brian, we really appreciate you taking the time for this and giving us some really useful information. And if anybody has any questions, here's the contact information for both Brian and us. Feel free to reach out wherever you think's appropriate, and we can try to answer those questions. So thanks everyone again for joining.
And I would just add here at the info at Integris Wealth, if there's a question that pops into your head and you don't know who to direct it to, in our office, that is the best email place to send it to.
Great.
Excellent.
Thanks everyone.
Yeah.
Appreciate you joining us today. Thanks, Brian.
Hey, thanks, guys. It was a lot of fun.